right, go for it.
All right, everyone. Thank you so much for joining us today. This is Brett Henderson, founder of Strategic Wealth Endeavor. We're doing kind of a different live stream today. This is something that's been coming for a long time, and I figured I was invited out here by Urban Catalyst, and I'm going to introduce these two fine gentlemen here momentarily. But rather than me just taking all this knowledge in and then trying to regurgitate it to my clients, prospective clients, I figure why not just take the horse's mouth and just blast it out there, right? So that's exactly why we're doing this today. So again, I'm Brett Henderson, founder of Strategic Wealth Endeavor. I will be handing over the microphone momentarily, but before I do, a couple things I have to say to keep compliance happy. So first and foremost, this is not tax advice. This is not legal advice. So anything we're saying is not a recommendation of a particular investment. Today is purely meant to be education. So this is educational in nature. If you have specific questions about any specific investments, this is not the platform. You can reach out to me. My email is below. I'm Brett Henderson. And if you have specific questions about a specific investment, we can talk there. But again, today is meant to be purely educational in nature. So we appreciate you taking some time. We're going to take about an hour. I'm just going to give a couple shout outs. I have Giselle, which she's not on camera right now. Actually, I'm going to put her on the camera because I can do that. There's Giselle. She's going to say hi. There's Giselle. She's kind of running everything behind the scenes. Any questions that come in, normally she answers them. So she's running everything for us. So Giselle, hi. She's like, don't put me on camera, but that's okay. And then we have Hiram Figueroa. Hiram Figueroa is my LinkedIn demigod. He handles everything and he gets everyone. He just gets their name, their brand out there. So Hiram's amazing. He's going to be running things behind the scenes for us. So Hiram, thanks for being here, and Giselle as well. And again, I'm Brett Henderson. I'm going to be handing over the microphone to Eric Hayden, the founder of Urban Catalyst, as well as his number one, P-Suit. And I'm not going to say P-Suit's last name. I'm just going to talk about that. But a quick agenda before I hand over the microphone will be number one, to say what we're going to do is just give the backgrounds, these gentlemen, then what is an opportunity zone fund, or what is an opportunity zone number one? How does it turn into a fund or an investment number two? Who would want to even consider an opportunity zone or investing in opportunity zone, excuse me, the good, the bad, the ugly, because with every opportunity, every investment, there's pros and there's cons. Right. So we're going to go through all that. This, again, is meant to be purely educational in nature. And I'm going to hand over the microphone right now. Actually, who wants to go first? Introduce themselves. P-Suit or Eric? Eric. All right. Here's Eric.
Hi. So thank you for the introduction, Brett. Very happy to be here with you, and thanks for coming to visit us. I'm Eric Hayden. I'm the CEO and founder of Urban Catalyst. Urban Catalyst, we started in 2018. We do real estate equity funds and ground up development. I've been doing real estate development for most of my career. It lends itself very well to opportunity zone funds. We'll talk a little bit more about that. And now here's P-Suit.
Thanks, Eric. Thanks, Brett. My name is P-Suit Centavale, and I'm the Director of Strategic Partnerships here at Urban Catalyst Funds. And really, my primary role is to make sure that our partners like Brett and his clients, and then all those out there, have the proper education tools necessary to make the proper decision for you, right? So my job and role is to build relationships and provide education. So that being said,
Oh, thank you. So we're going to be sharing one mic, so hot mic, so bear with us there. We have some awkward handoffs here. We're all friends, but we're not that close, right? So that being said, let's start with the basics. What the heck is an opportunity zone?
Sure. So opportunity zones were created as a part of the 2017 Tax Cuts and Jobs Act. So that's when they were created. It took the federal government about 2 years to really clarify the program. And what opportunity zones are, they're census tracts. And in general, they're lower income census tracts. Really, the federal government said, okay, here is what qualifies as a census tract. And then they allowed the state governments to choose 25% of the eligible census tracts. Here in the state of California, the governor chose our opportunity zones in April of 2018. In general, the program was created to really create positive social and economic benefits into lower income areas. And overall, it has been pretty successful. I would say as successful as they'd anticipated that, well, at least when they created the program, what they wanted to see out of it has been happening.
Thank you for sharing that, Eric. And so with that, you're saying each state determines their own opportunity zone, or how is a area declared or determined to be appropriate or be classified as an opportunity zone fund or opportunity zone? Excuse me, am I using the right terminology? Who wants to handle that? You or Pursuit?
So, as a census tract, when they look at the income levels of the people that live in that census tract, they look at the levels and they look at it versus some of the surrounding census tracts to see how it relates. So if it meets a certain threshold, that's what is created an opportunity zone, at least the ability to be an opportunity zone. The federal government, when they designated what qualifies, they really didn't reinvent the wheel. They looked at the census tracts that already qualify for below market rate housing tax credits. So they rolled all of those out and they said, okay, states, you choose yours. And when the states chose their opportunity zones, they could choose 25% of those tracts. And they did things like, well, we don't necessarily want to choose a census tract that's near a college because college kids don't have a lot of income and that's going to, change the overall demographic, examples like that. And then of course, a lot of the individual cities lobbied their state government to have opportunity zones located in their cities. Some were successful and some were not. By the end of 2018, almost every state in the country had identified their opportunity zones.
Okay, so what would be the difference? As I'm hearing you speak, I'm thinking, what's the difference between a HUD zone and opportunity zone, or is HUD and because that used to be HUD, right? Or well, that's when you're speaking, that's what's triggering my mind. So ignorance is bliss. So help it. This is here. I'm here for education. So make me smart. What's the difference between a HUD zone and opportunity zone?
I'm not exactly sure what a HUD zone is.
Well, I know in certain cities, the dilapidated areas, if you set up a shop there, set up your business there, you get tax credits or tax incentives for developing a business. I don't even know. I wish Alex Hernandez, if he was on here, he knows what a HUD zone is. So it's housing, urban development, I think, something along
Yes,
those lines.
the Department of Housing and Urban Development is HUD.
HUD,
and they do
HUD,
provide.
Sorry, that's my ignorance.
They do provide a lot of loans
HUD
and
zone,
different types of assistance for homeowners, but especially when it comes to loans and insurance on properties. They also do some below market rate programs. So that's kind of the federal government doing that. I don't know if they actually do it by zone or if they do it by city or they do it by county.
Is there overlap between an opportunity zone and a HUD zone then?
I'm sure there is. I mean, opportunity zones in general are just census tracts in lower income areas. So if there are HUD zones that are also available there, then there might be.
But Eric, could you describe? But Eric, could you describe when you say lower income tracts? I mean, I would say that not all opportunity zones are created equal, right? Because some opportunity zones, and there were, when the Tax Cuts and Jobs Act identified these, they identified over 8,700 different locations to be opportunity zones.
How many?
Over 8,700, nearly 9,000 across the United States. But not all of them are created equal. Could you maybe give the definition of how some of these areas qualify? You mentioned low income, but low income as compared to what?
So it's really low income in compared to the surrounding census tracts. So right when the program was first created, a lot of news agencies did stories. Well, what are the best opportunity zones in the country? And there are some pretty good ones. We're located here in San Jose, California. We have 4 opportunity zones that cover almost all of our downtown. Seattle, almost the whole southern part of Seattle, parts of Miami, Chicago. There are great opportunity zones out there that you would think, for example, our opportunity zones here in San Jose, you would think, well, isn't that Silicon Valley? Like how would an opportunity zone be in Silicon Valley? And it's because the surrounding census tracts, the people that live there make significantly more money than the people that live in downtown San Jose. That percentage different, that's what qualifies downtown San Jose's census tracts.
Okay. So thanks for clarifying that a little bit. And if you have questions along the way, just please send them in and we'll try and put them on the screen and address them as they come in. So you're welcome. This is meant to be interactive as we're doing this live. So thanks again for tuning in and learning about opportunity zone funds. So my next question is then, so once the federal government has identified these census tracts as qualified opportunity zones, then how does Wall Street more or less take that and turn it into a investment that someone can actually invest in with the hope ideal of trying to make some money, right? So as a reminder, again, I have to say this is not a product pitch. We're not talking about any particular product. This is not tax advice. This is not legal advice. This is just meant to be educational on how opportunity zones work and how I guess Wall Street turns them into investment products.
Sure. So when they created opportunity zone funds, really it seems as simple as you can form an LLC, you can call it an opportunity zone fund. If you fund it with a certain type of capital, it qualifies as an opportunity zone fund. There are a lot of rules you have to meet. One of the biggest rules associated with opportunity zones is that you have to do something called substantial improvement. And substantial improvement means you have to have a project, a piece of property. You have to put money into that property of equal or greater value to the structures that are currently existing on that property, not including the value of the land itself. That's kind of the big, huge rule. There are a lot of rules, but that rule makes opportunity zone funds. It seems that the best way that translates to, well, how do you create an opportunity zone fund to meet those rules is to do ground up real estate development or to do large renovation projects to existing real estate. Now, when they first created the program, what they really wanted was these funds they wanted people to invest into these funds, and then these funds would then invest into these opportunity zones. And they especially wanted to invest into businesses located in these opportunity zones, although there was still the requirement for substantial improvement. So you could think perhaps like on a smaller scale, like a flower shop that wanted to do some tenant improvements and build a new parking lot and put a new roof on. That would be substantial improvement to the building for that business. So you could create an opportunity zone fund that would specifically do that. Now, what it turned out was that most opportunity zone funds in America, it's large real estate development projects. People raise funds and then they put money into ground up real estate development because you spend obviously a lot of money when you build a new building, significantly more usually than the value of the existing structures. Yes. So that's kind of the big rule and why opportunity zone funds in America have really centered around ground up development and large renovation.
That makes sense. So every state now, what we think almost every state has opportunity zones, and then who is creating these opportunity zone funds? You guys are a fund. You're just one example of one firm doing that. But what is the presence nationwide since 2018 for Wall Street, more or less, coming in and trying to help invest back in these areas? To obviously you have to make a significant capital investment into an opportunity zone for it to qualify, right? So there's tax incentives to do it, but you have to put the money in to get those tax incentives. So can you just briefly describe from a 30 or 60,000 foot level, when you look in an opportunity zone, are you looking at particular projects or buildings or an area, or how would you say, yes, this is one that we think would make a worthwhile investment? How do you determine if an opportunity zone fund is opportunistic for you and your firm as a CEO of a firm?
Well, sure. So maybe to describe, before we get to exactly how you determine which fund that you want to choose, maybe we should describe, what type of capital is eligible to get the tax benefits associated with opportunity zones and what those benefits are, because they did give pretty significant tax benefits associated with investing into opportunity zones. So the first thing is the government wanted to get capital off the sideline and invested into these opportunity zone funds so that they could then invest into opportunity zones. And to get capital off the sideline, you could think, well, there's a bunch of people that own a lot of real estate or own businesses or own stock. And if they sold that stock, when maybe they've been holding it for a long time, it's going to generate a capital gains event. And that's money that the government likes to get. They like when people sell stock because then people have to pay taxes. So they said, if we could get people to sell their stocks, sell their businesses, sell their real estate, generate capital gains, then if they invest that capital gains into an opportunity zone fund, then they get those tax benefits. And by the way, it's any type of capital gains is eligible. It's short-term capital gains or long-term capital gains. And capital gains, I mentioned the three primary sources, right? Sale of business, sale of real estate, sale of stock. But I mean, it could be the sale of artwork. It could be the sale of, commercial machinery. It could be, we even have several folks that sold Bitcoin. So anything that generates capital gains is eligible. Once that capital gains event occurs, investors have 180 days to put their money into a qualified opportunity zone fund to get those benefits. So there is a timeline associated with it.
6 months.
6 months. And then the two primary tax benefits that these investors get, number one, they're able to defer paying capital gains taxes on that initial capital gains event until they pay their taxes in 2027. So you get to defer for a couple of years.
Okay.
So that's number one. By the way, that's for everybody, that 2027 date. So when this program was created at the end of 2017, if you'd invested in 2017, you pay those capital gains taxes in 2027.
So
Everyone has this one date.
Okay.
The government also, as I mentioned, it took them about 2 years to clarify the program. So it wasn't really clear until the end of 2019. They came out their third round of clarifications in December of 2019. And when those came out, it finally said, okay, here's all the rules. And everybody understood it. There was no more confusion. But it did feel to the insiders in the opportunity zone world that we kind of lost 2 years of time. So if there was a 10-year program, it was really closer to an 8-year program.
Well, now we're down to a 3 or 4 year program.
That's right. So now we're down to a 4-year program or so, a little less than 4 years at this point. But that's the first benefit.
Okay.
Defer your taxes till 2027. Number two, and this is the real benefit, after they invest into an opportunity zone fund and their money seasons in that fund for 10 years, all of the profits from the fund itself are tax-free. So that's really the best thing about it, right? Is you invest into ground up real estate development, you invest into large renovations. And by the way, there's several other types of opportunity zone funds out there. I'm just kind of mentioning what is the most common. You're investing in these funds, and these funds are structured like traditional real estate equity funds that do these type of projects and they expect returns of that nature. So, theoretically, there will be profits by the end of 10 years. Hopefully. And if there are profits at the end of 10 years, then investors get those tax-free. So that's a huge thing. It's kind of like, it's almost like a Roth IRA, right?
Tax-free.
Tax-free profits. That's great on the out when you get out.
With that, okay, now my mind is thinking, so what type of investor, and I already know the answer, but to invest in these, normally an investor has to be accredited. So P-Suit, excuse me. Please help explain what an accredited investor is for us.
Sure, no problem, Brett. Before I go down the path of the definition of an accredited investor, I do want to answer your first question was how many other groups or programs are out there providing opportunity zone funds? Well, as Eric mentioned, in 2017, that's when these opportunity zones were created. However, they weren't finalized until 2019. Since 2019, over $40 billion have been invested into opportunity zones across the country, right? $40 billion have been invested throughout multiple programs with multiple sponsors. We are just one of many. But, the majority of that $40 billion, however, hasn't been spread evenly across 8,700 different locations, right? Because at the end of the day, what good are tax-free profits if there are no profits? And that's a quote that I'm stealing from Eric here. And there are many programs similar to ours that fall and qualify as an opportunity zone purely by definition, purely because the median household income of this census tract just happens to be lower than the median household income of its surrounding census tracts. The reason why that's important is because if you look at San Jose itself, the median household income in San Jose is over $100,000, which is well over the national median household income of about $60,000. But when you compare this particular area to its surrounding neighborhoods, those census tracts in some situations are double or triple that of San Jose. So by that definition, this area qualifies. And there's other areas like that all across the United States. And that's where the majority of that $40 billion of invested capital have gone into for opportunity zones across the country. Now, the question is, well, where's that money coming from, or who is it coming from? Well, typically, as an opportunity zone program, opportunity zone fund, most opportunity zone funds, I would actually say almost all, are long-term investments, right? These are really suitable for those types of investors who have the ability to withstand at least a 10-year holding period. Because remember, the IRS requires you, this is an IRS requirement, the IRS requires you to be in an opportunity zone fund for a minimum of 10 years prior to the sale of those assets for a profit. After 10 years, the sale of those assets and the profits thereafter are then tax-free. So that 10-year holding period is a long duration. And so you need really an accredited or sophisticated investor who has the ability to withstand that time. And so the definition of a credit investor is anybody that has made at least $200,000 a year for the last 2 years with the ability to make it in the third year as a single filer. Or if you're joint filers, you have to make $300,000 a year with the ability to make it for the last 2 years, with the ability to make it in the third year. Or the other definition is somebody or some entity or family that has $1 million of personal net worth, not including their primary residence. So these are deemed as accredited investors. They have the ability to not necessarily need the access to this capital right away, but because of that, because they're giving up liquidity, the potential for long-term tax-free appreciation and growth is what is the draw, right? Not just the deferral, the taxes, but the potential for that tax-free growth and significant tax-free growth is the draw for that. But it is a longer-term investment, and there is, in most of these funds, no liquidity provisions.
Thank you for clarifying. And as you're having this conversation, I think most investors are familiar with the term 1031 exchange. And so some may be saying, well, it's popping in my mind. So you think of a 1031 exchange, there's tax advantages there. You're delaying or deferring the taxes until the sale of the next asset. If you sell a building or an investment property and you take the proceeds and invest them into another one, you're deferring the capital gains. What's the difference in layman's terms for an investor who may not have a lot of experience in this area? What is the main difference between a 1031 exchange and an opportunity zone?
So the first thing, we get this question quite a bit. And the first thing to know is that 1031 exchanges have nothing to do with opportunity zone funds. I mean, they're completely separate tax benefits. I mean, you might as well say, well, what's the difference between opportunity zone funds and below market rate housing tax credits or conservation easements or, Maltese trusts? There's a variety of different types of tax advantaged, things out there. But the one thing that is really common for both 1031 exchanges and opportunity zone funds is it's a deferral of capital gains, and you have that 180-day period. So people that sell real estate have the option, if they want to do a tax advantage program, of either doing a 1031 exchange or doing an opportunity zone fund or doing a combination of both. 1031 exchanges in general, you're able to defer paying capital gains really indefinitely. You also get to defer depreciation recapture. You have to buy a building of equal or greater value to get the full benefit of the 1031 exchange. You have 180 days to do it. Very simplified. You have to identify 3 properties within 45 days and then close escrow on one of those 3 properties within 180 days. The big benefits, of course, tax deferral indefinitely and depreciation recapture deferral indefinitely. And then, of course, what a lot of family estates and trusts like about 1031 exchanges is you depreciate that asset on and on and on. You buy a bigger asset, you continue to depreciate it. Eventually, you can't depreciate anymore. When you die and it transfers to your heirs, there's a step up in basis, and that depreciation continues again from brand new start. Opportunity zones and opportunity zone funds, yes, same 180 days. Besides real estate, it's any type of capital gains. So folks that have sold stock for the first time have some options as to how they could have some tax advantages because they've never really had a program like that before. And we're able to defer paying capital gains taxes till 2027. But the difference really for opportunity zone funds is after 10 years, you get out of it and you get tax-free profits. You don't have to wait forever until you die. However, 1031 exchanges have been around 100 years. So it's a very familiar program for people, for brokers, for accountants, for everybody. Opportunity zone funds have only been around since 2017. So it's still pretty new. We don't see a whole lot of competition. It's like if people are doing a 1031, most likely they're going to do a 1031. Now, I mentioned when you do a 1031 exchange, people have greater or equal value. So if you sold a building for $5 million, you have to buy a new building for $5 million plus. Okay. So at a minimum, you have to invest what is your basis. So if you bought that $5 million building for $1 million, you have to invest that $1 million basis plus whatever capital gains you want to defer. then you could pay taxes on the rest if you want. They call that the boot.
Okay.
Okay. Opportunity zone funds, you don't need to reinvest your basis. You're only investing your capital gains. So that's kind of one of the big differences in the two programs. And then another thing that we see a lot of is folks do a 1031 exchange. Same example, they have a $5 million building they sold. They only found one for $4.5 million that they really liked. And so what they do is they do their 1031 exchange. They have $500,000 in boot left over, and they put that into the opportunity zone funds.
Or another situation that occurs is they can't find a suitable property within their 45-day identification window. Then what happens? Well, they could go out and pay those taxes on the sale of that, or they could take the gain portion, invest that into an opportunity zone or any portion of the gain, and then keep the cost basis for themselves if they so choose. So for those who are very familiar with 1031 exchanges and you've done them and you have a hard time finding a suitable property within that 45-day window, if you don't identify and your money gets released, well, you still have now the remaining 135 days to invest into an opportunity zone to defer paying those taxes. Now, if let me just add one more thing. The unique difference, though, between the Opportunity Zone program and 1031 is that the Opportunity Zone program, in my opinion, allows for maximum flexibility when you have any type of capital gains event. 1031 exchange are a fantastic program for those that have a sale from an income-oriented property, real estate. Opportunity zones, however, can be for any type of capital gains, as Eric mentioned. It can be from sale of stock, sale of business, sale of collectibles, but it could also be from the gains from the sale of a primary residence. Now, you're based in Southern California. I'm sure you have lots of clients that maybe bought their home 20 years ago for a very low cost basis of $300,000 to $500,000. And now here we are 20 years later, they could probably turn around and sell that home for $2 million plus. Well, if they're a married couple, right? They get to say they bought it for $500,000. They sell it for $2 million. They get the $500,000 cost basis tax free. They get $500,000 as a tax exclusion. But guess what? That $1 million of gains they have is fully taxable. What is the solution for them to help them pay those taxes or defer those taxes or mitigate those taxes? Well, an Opportunity Zone program is a great strategy for them because you can invest the entire $1 million or any portion thereof. And if you invest just a portion of the $1 million of gains, you defer basically just that portion, right? If the client wants to go and buy another property for $1.5 million cash, they can do so. They can take the $1 million of $500,000 cost basis, $500,000 of tax-free exclusion, $500,000 from the gain. They'll have to pay the taxes on the $500,000 they're using, invest the other $500,000. They could defer now 50% of the taxes owed until 2027. So again, it just allows the client flexibility to meet their needs, right? Their lifestyle needs, their current situation, and it allows them more time because with a 1031 exchange, right, you have 45 days to basically identify. With an Opportunity Zone, you truly have 180 days. And then if you're a business such as an LLC or an S Corp or partnership, you actually had an extended time frame, which we can talk about some more later here. But again, depending on your situation, the Opportunity Zone program does allow for a lot of flexibility and optionality.
To continue talking about 1031 exchanges, another thing that we've seen recently, a lot of folks out there that sold real estate, we're seeing a lot more people invest into our fund that sold real estate. And that's because as interest rates have started going up, when people have already sold a property and they're in that 180-day period and they want to do that 1031 exchange, maybe they identified 3 properties, but maybe now those properties, they can't get the loans that they need to close on those properties, or the loans just aren't worth it and they're making the returns too low. And in some cases, maybe they find environmental contamination on their property, or there's some issue with the closing that it just isn't going to occur within 180 days. And they're stuck. So a lot of times we get these frantic calls from people. It's day 179. Is it too late? Can I still come in? And I will say we have managed to do the whole process of intake of an investor in 24 hours, but I highly recommend taking a little more time than that.
Don't encourage that.
But we have seen that influx lately, especially from folks who are like, well, geez, I had to sell the property for some reason. My parents passed away and I inherited this property, and my brothers and my sisters, we had to sell it. And now here I am. What am I going to do? Another kind of interesting thing when it comes to 1031 exchanges is A lot of times properties are owned in partnerships. So like an LLC owns a property, and then there are like 5 owners of the LLC. Well, to do a 1031 exchange, you have to have a different ownership structure. You have to be what's called a tenant in common. And the IRS in general, and by the way, this is, again, we are not accountants and this is not hard and fast accounting rules, but the IRS in general requires you to drop out of your LLC into a tenant in common structure for at least 12 months prior to the sale in order to do a 1031 exchange. If there is the option, if all 5 partners in this example all want to roll into a 1031 together and they can all agree on a property, they can. But that's very unlikely. I mean, in some cases, there are 40 people that own these LLCs. So dropping into a tenant in common also takes time and strategy. A lot of times, if you're selling a property, it's because the partners aren't getting along or one partner wants to sell. And there's a variety of reasons. If that happens, it's the sale of a business. You're selling that LLC. And so you can't do a 1031 exchange, but you can do an opportunity zone fund, because the sale of a business is a capital gains event, and a capital gains event is what qualifies.
Okay. As I'm sitting here digesting this phenomenal information, and it's a lot of information, and if there's questions out there, please ask for further clarification. I'm going to throw it out there. Say I'm a do-it-yourselfer. I'll give you 2 scenarios. I'll ask you for your thoughts. Say I was Facebook employee number 50. I'm in San Jose. I've got several $1 million of appreciation, long-term capital gains, and now Meta stock. That was Facebook stock. And I say I want to sell, and I've got $2 million of capital gains. What happens if I want to do it on my own? Right? Can I, as an individual investor, invest in Opportunity Zone and just do it myself? I don't need a fund. I don't need other people. I can do it myself. So can people do it on their own? Or say I bought that house for 200 grand way back when, and now it's multiplied 10x. Now it's 2 million. Same situation. I want to sell that house, go somewhere else. Not sure, but let's say I've got $2 million of capital gains from real estate, $2 million of capital gains versus stock. I want to do it on my own. I don't want to go into a fund. Can I invest in an Opportunity Zone or Opportunity Zone itself on my own?
The answer is you absolutely can. You can form an LLC, call it an Opportunity Zone, meet all the rules and regulations, do all that substantial improvement. One thing that we discuss with our potential investors quite a bit is how much money does it take to actually be worth it? Because there is pretty significant accounting and reporting requirements. You know, we haven't got into like the structure of how funds are structured, but they're pretty complicated structures that require a lot of reporting. Kind of in our mind, 10 million is kind of the minimum that you would want to do. So if you had $100 million capital gains event, great, you can form your own fund. That would be a piece of cake. If it's only 5 million, you might think twice about it. It's also, you're going to be responsible in order to meet the qualifications of doing a ground up development project or a large renovation. You know, are you qualified to do that? Do you have the time to do that? Are you a professional developer? If you are, fantastic. If you're like, well, I remodeled my house, probably not.
Understood. Very good question. A very good answer there. So another thought would be then, okay, if I want to research this further and I want to run it by my CPA, and hopefully there's some CPAs on here right now, what are you finding the knowledge level or expertise in the CPA community? Because these are newer investments, right? And a lot of CPAs are quote unquote stuck on their ways. And yes, there's new changes all the time in tax law. How are you seeing the education for your own clients when it comes or in regards to investing in Opportunity Zones, or if their clients want to invest in Opportunity Zone fund and someone reaches out to you, what is the level of education or explanation that is normally appropriate or needed to help articulate the process of investing in an Opportunity Zone for a client's CPA?
So I'll start to answer this one, then I'm going to pass it to P-Suit. But we've seen in the last couple of years that obviously, you know, as more years go by, people are more and more educated, especially CPAs. We're finding we're getting more referrals from CPAs these days than we were before. I will say at the beginning of the program, you know, as part of the Tax Cuts and Jobs Act, and Trump is a very polarizing figure in national politics. And right at the end of 2018, all of these articles came out. Trump did this for his own benefit. He did it for his kids. And of course, we, you know, here at Urban Catalyst, we do a lot of advertising on Google and whatnot. and our Google AdWords hits spiked through the roof. We were paying like $50,000 a day for like 3 days because we were getting so many people that were interested in opportunity zone funds. That was kind of the beginning of the education. Back then, people were coming to us going, what is this? What is going on? Now, most of the people that we talk to, they come to us with a lot more intent. They know what they're doing. They've researched opportunity zones. It's more of a common thing.
Yeah, thanks, Eric. I'll echo what Eric's saying. I think at the beginning of the program, including all of us, right, we were unfamiliar with what an opportunity zone program is. Many CPAs have heard of it, but most have heard about opportunity zones that were in areas truly of economic destitute, because the intent of the program is to revitalize areas that are deemed economically distressed. And so many CPAs, I think, maybe kind of put that in the back of their mind and say, you know what, yes, my client has a significant capital gains event. Yes, they have a significant liability, but I'm not necessarily going to refer them to invest into an opportunity zone that I believe is in an area that is not economically viable long term. And so what sponsors, just like us and others across the country, when we started coming out with programs, started looking at opportunities out there in opportunity zones, pardon the pun, right? That might not be as economically destitute as some of the other 8,700 different opportunity zones across the country out there. And so what CPAs are starting to find through partnerships with advisors just like yourself, right, that they can have access to, call it institutional quality real estate that just happens to have the tax benefits of opportunity zones. There are several programs out there, lots of groups out there that are providing now clients have access to institutional quality real estate that happens to have the tax benefits of the opportunity zone program. And now those CPAs are starting to refer, right, those clients to these opportunity zones, to financial advisors who have access to those opportunity zones, because most of these opportunity zones are structured and are only available through licensed individuals, right? SEC licensed individuals. And that's why this is a purely educational broadcast, and we're not talking about any specific funds or strategies here. But again, as time has evolved, as time has gone on, CPAs have become much more comfortable. The advisors are becoming much more comfortable. They're getting much more education on programs just like this. And they're starting to realize that, hey, these are truly viable options for their clients.
Just a kind of an interesting comment. When we go out and present to different broker dealers and RIAs out there across the country at conferences, it used to be we'd have to have a bunch of slides about here's what an opportunity zone fund is, and here's how it works. And now we are getting requests. Please take out all information about how opportunity zone funds work. We all know. Thank you.
Okay. Well, that's great. So this is why I'm here. Maybe if you guys all know this, great. You don't need it, but maybe I think a lot of us do. So as I'm sitting here listening, a question that's popping into my mind, or a quick summary. This is a real estate investment, period, with potential phenomenal tax advantages, period. Potential. Nothing's guaranteed, right? Just potential. So that would be the litmus test, so to speak, versus investing. If you have two real estate options or investment opportunities in front of you, one's just buying a building in a regular place and rehabbing it, or building your own building, and or building one in an opportunity zone. All things being equal, the tax advantages of building in the opportunity zone could outweigh the benefit of investing in this similar type of property not in the opportunity zone. Is that a nice summary or simple assessment?
I'd say so.
Good. So that being said, what about tax management when it comes to your clients, or anyone saying, well, why would I do this if this tax deferral is only 2027? Is the year 2027 a stigma for some people they can't get through? Because even though it's a 10-year hold, some people might be saying, I have to pay taxes here. I need additional cash flow to pay the taxes in 2027, even though it's a 10-year illiquid investment. Illiquid means for 10 years, you're not touching it. Imagine you don't have it. Imagine you don't own it. It's like a genie in a bottle. It doesn't exist. It's just there. So any challenges with helping investors and or CPAs understanding the difference between tax management when you've got that 2027 window versus the 10-year illiquid time frame where you can't touch, expect nothing back?
Sure. So a lot of funds have created structures where there are refinance events to make distributions prior to the 2027 tax date. It's a very common structure out there across the country. And it's very typical for real estate development or large renovation projects where you build a building. Now the building is worth more than you put into it because you have a tenant. You go out and get permanent financing, you pay off the construction financing, and then there are excess refinance proceeds, and you can make that distribution. Because that's a distribution of debt, kind of like a home equity line of credit, it's a tax-free distribution. So a bunch of the funds out there that we see have that structure built in. Now, as we're getting closer and closer to 2027, it's a lot harder to build your building, lease it up, stabilize it, refinance it, before that April 15th, 2027 tax date. So that's becoming more of an issue for, say, newer funds that are just starting. There is a little bit of legislation out there that has been talking about extending the program so you don't have to pay your taxes till 2029.
Okay.
It was proposed in April of last year, and we thought it would be attached to one of the budget bills towards the end of last year. And when I say we, I mean the national working group that advises the Treasury and the IRS on any ongoing opportunity zone legislation. My partner, Sean, is a member of the working group, so he takes really detailed notes for us. That was their opinion. It did not get attached. Now their opinion is it'll be attached to one of the bills at the end of this year.
Okay.
So it's still out there. It's still floating around. It does a couple of things. When the program first started, there was also additional tax benefit. There was a third major benefit. And that major benefit was if you invested, and this is in 2019 and 2020,
okay,
you got a 15% discount when you paid your taxes. So if you owed $100 in taxes, you only pay $85 in taxes. In 2021, that dropped to a 10% discount. And then in 2022, it went to zero. The new legislation would retroactively give everyone the 15% discount. And then if you invest this year, it'd be a 10% discount.
Interesting. Eric, if I may. Just to add a little clarification on why 2027 is the hard date everybody in every opportunity zone has to pay their taxes, is because the way that the current opportunity zone provisions are written is that the current opportunity zone provisions or code sunsets December 31st, 2026. That's why every opportunity zone fund, whether it's ours or any other sponsor, everybody has to pay their taxes in 2027. Now, if this legislation is let's say approved this year, that would then move that date back from December 31st, 2026 to December 31st, 2028. That's why your taxes would then be due in 2029. Just for clarification, it's not something mandated by us. It is an IRS tax.
Mm-hmm. Another thing, just to further clarify, the program itself goes through 2047. So just because you can't invest after December 31st, 2026, doesn't mean that you have to sell your buildings by then. You have a lot of time to sell your buildings. Or, in some cases, some funds, they don't sell their buildings. They just collect rent and income. And if they have things going on, that is tax-free as well.
Okay. So for a potential investor, is there I'm thinking of estate planning and supplement basis and so buy and hold. Most real estate, I grew up with buy real estate and never sell it. Buy it, hold it, never sell it unless you need it. And I started my own business. And I had to sell 3. All right. So it's hard to do sometimes. I like real estate though, because it's a piggy bank, right? It's a piggy bank. If you need it, it's there. You can sell it. So if this program is going long term, is there a particular average investor that invests in these funds or would get the most benefit? Is there, if you're stereotypical mom and pop or Bob and Bob or Bob and Jenny or whoever, is there a traditional or who is your average investor that would look at potentially investing in an opportunity zone and or an opportunity zone fund?
Sure. So our fund might be a little bit different than other funds. I've heard this question at conferences, and different fund managers answer it differently. I was actually somewhat shocked I thought everybody was going to be just like us.
Okay.
But obviously we're here in Silicon Valley. So we have a significant portion of our investors are somebody who's been at Facebook for 15 years or Google or Amazon or, Microsoft, any of those big companies around here. We have investors from those companies. And here is like our prototypical investor. They have a couple $1 million in stock. their primary net worth is tied up in the stock in the company that they work for and their primary residence. And any wealth advisor out there is going to say, you should never have your entire stock portfolio concentrated in one stock and a house. You need to diversify your portfolio. Obviously, stocks and bonds diversity is very common. Almost everybody will say you should also invest into real estate, at least a certain percentage of your portfolio. But the big thing for these folks is, well, I never wanted to sell my stock because I'm not going to take that huge tax hit. Why would I do that? If my tax hits 30 to 40%, how am I going to make 30 to 40%? It's going to take me years to get back to where I was before. So that's where opportunity zone funds really come in. Now you can diversify your portfolio into real estate while getting these additional tax benefits. So that's who we see as our primary beneficiary. But like I said, there are folks that, sold their dentistry, sold their, doctor's practice. They sold an insurance company, and they're not huge business sales. It's not like they sold their business, some startup for a couple $100 million. they sold it for a nice profit, maybe enough to retire. And now they want to diversify some of that into real estate. And this is a great way to do it. Sure.
Yeah, I mean, here's a great example of one of our investors, right? Looking at their portfolio, they had a $1.2 million stock portfolio. In that 1.2 million, 450,000 of it was unrealized gains from the Apple stock that they bought for, I think, a $6,000 cost basis, right? For that client, shaving off $100,000 to $200,000 of that $450,000 of unrealized gains helps to de-risk them from being over-concentrated in one stock, diversifies them into hard asset real estate, but also uses a tax efficient strategy, opportunity zones, right, to not only defer the taxes until a later date, but also to potentially provide long-term tax-free growth. So it's just a strategy. Well, that's one of the strategies that we've seen. What was the last comment you made? Because there was another comment I wanted to make on that.
Sale of business.
The sale of a business. We see from our end, especially working with advisors, a lot of the clients who come in from our financial advisor are clients that sold their business, right? And the typical business sales are they call it, they sell it for about $1 million to about $5 million. Again, to Eric's point before, these are great. I mean, look, congratulations to that business owner. That's a great payday for them, but probably not large enough for them to be a DIYer and go create their own opportunity zone fund. So what a great way for them to still take some risk off the table, right? For them to take some to help mitigate some of those taxes, invest into an opportunity zone, maybe keep some of the cash cost basis in their pocket. But this helps them to potentially get a second bite of the apple. Because again, that potential for long-term growth with most of these funds is fairly significant. And now you can have a second bite of the apple from the profit you already made from your first sale.
Thank you for clarifying. And as you're sharing this, let me ask the question. So if I own an insurance agency and I sell the insurance agency, and say I sold it for $5 million, for example, not 50 million, but 5 million. But that's my retirement nest egg, right? And say my basis was $500,000, right? So I have 450,000 of capital gain, or 4.5 million of capital gains in there in that scenario. But I'm planning on, I'm going to pay taxes. I'm going to pay 2 million in taxes, and I'm going to take my other 3.5 million or so, or 3 million, and I'm going to use that to live off of and generate income. Well, if I invest in an opportunity zone or opportunity zone fund to defer those capital gains, I still have to pay those capital gains. But if I was going to use that money for income, is there a way potentially for an opportunity zone investment or fund to generate income? So if I sell my business, and that my business was my baby, my cash flow, is there a way then to take the proceeds, invest in opportunity zone, and generate income for my retirement potentially?
There absolutely is. And, not every opportunity zone, as I mentioned, every fund is created the same. So in some cases, that is an opportunity zone fund strategy. They're going to do this project. Perhaps they don't use any debt when they build the building. They build it with all cash. And now the building is, complete and stabilized and cash flowing, and they're giving a percentage return to their investors. Now, that return in general is not tax advantage. You're just paying taxes on income from property. In some cases, just like the ownership of real estate just has an inherent value of being able to depreciate a stabilized asset. and passing through losses. And in some cases where the investors are real estate professionals or could call themselves real estate professionals on their tax returns, they can use those passive losses to offset the passive income from those real estate properties. So that's a kind of a good thing. More likely, opportunity zone funds are structured like traditional real estate development funds, where you're not so much looking for ongoing cash flow on a month-to-month basis. You're looking for an internal rate of return and returning as much money as soon as you can. So having a large refinance event, then some cash flow, and then a huge hit at the end when you sell the assets after 10 years, that is more aligned with a traditional real estate equity fund for ground up development.
But Brett, using your example, right? So now you've sold your business for $5 million. You had $500,000 cost basis. Now you have $4.5 million of capital gains in which you owe taxes on, right? Let's assume 30% because the max capital gains rate is 20% plus 3.8% for the Medicare surtax. That puts us about 24. And then if you're in the state of California, that's another 13% at the max rate, right? So now you're at over 37, but just round it down to 30%. So $4.5 million at 30%, what does that come out to be? That's call it $1.5 million of taxes, right? Now, the beauty again of the Opportunity Zone program is it allows you flexibility. You don't have to invest the entire $4.5 million into Opportunity Zones. Now, you invest whatever portion you want, and that's a portion you're going to defer your taxes. So if you are looking for other income sources, but you also want some long-term tax-free growth, you could take a portion of the $4.5 million, invest it into Opportunity Zone, take the other portion of the $4.5 million, invest it to some other income producing assets, right? That generates you current passive income now. And the beauty of Opportunity Zones that are set up as real estate development funds, many of these Opportunity Zones, once the buildings that they've constructed have gone vertical, will be able to supply passive losses due to maybe bonus depreciation of those buildings. So now when you have a client that you've set up on that $4.5 million, diversify them in different assets, some that are income focused, some that are growth focused. Well, those growth focused investments like an Opportunity Zone, once they start providing those losses, you could potentially be able to use those losses to offset the income that you've created for them. It's creating a long-term tax efficient strategy for both the income and the growth side. So with $4.5 million, you actually have a lot of flexibility to provide the best solution for your client.
Well,
add some to that.
the only thing I want to add is, of course, P-Suit and I, we work for Urban Catalyst, and we provide different types of funds. We do not provide advice to individuals on how to, allocate, $5 million into a diversified portfolio. That's really left up to your advisor and your accountant.
Yeah. And so with that, as we kind of bring it around for full circle, it's almost been an hour. Is actually are any other thoughts or basic one-on-one pieces that we should have touched base that we haven't discussed?
Yeah. So one of the nice things about Opportunity Zone funds, and a lot of funds across America have figured this out, right, is to take advantages of all of the tax benefits associated with the ownership of real estate in combination with using a passive entity like an LLC, as well as the Opportunity Zone program. And I'll give you kind of how this all works together. So you invest into an Opportunity Zone fund. After a couple of years, the buildings are built and stabilized. There's a refinance event and a distribution to the investors from that refinance event. I mentioned that's tax-free because it's like a home equity line of credit. So you get a big tax-free distribution. Lovely. Then you start collecting depreciation. A lot of times the depreciation is larger than the amount of income that you're getting from the properties, depending on how much you took out for your refinance event. So you can have all of this cash flow coming in that is offset by the passive losses that you're passing through using an LLC to pass through passive losses. Then as time goes on, we mentioned earlier when we were talking about 1031 exchanges, how depreciation recapture is something that people want to avoid. Well, specifically for Opportunity Zone funds, there is no depreciation recapture. So at the end, we pass through as much passive loss as we can, and you don't have to pay it back. It's not like you're deferring it. It just disappears.
It's free money.
It's just, I don't like to say that on LinkedIn.
Well, I'm a simpleton. It's free money, right? It's free money. Versus if it was recaptured, you have to pay taxes on that. So compared to traditional scenario, that is free money. That's a fair statement.
And then here you are at the end, you sell the buildings after 10 years. And not only is there no depreciation recapture, but you get tax-free profits because of the Opportunity Zone program. So it's like you get tax-free refinance event, potentially tax-free cash flow, no depreciation recapture, tax-free profits. It's almost like they've never created a program with this many incentives all bundled into one.
That's awesome. Thank you for sharing that, Eric. But Sue, what are your final thoughts as we bring this home?
Well, thanks, Brett. And first, I do want to recognize and thank you for your service. And I know that many of your audience here have been former service members, so we want to we want to show our appreciation to all of you. Thank you so much. Again, I don't think I can emphasize enough how the Opportunity Zone program is really kind of a gift towards anybody with any type of significant capital gains. Again, speak with your advisor, speak with a tax professional. But if you're in a situation where you have a significant capital gains liability, an Opportunity Zone could be a potential solution for you because it provides, again, like I said, optionality and flexibility. I do want to mention one thing. We mentioned the 180-day window, right? If you are an individual or entity such as a trust, from the time you sold, say, that stock, or you sold that property, you sold your house, you have 180 days from that date you received those funds, which is 6 months. And you can look back as well, right? However, there is one nuance, though. If you sold your business, your partnership, your S corp, maybe you were a dentistry practice and you sold it in January of 2022. You put $1 million in your practice and you sold it for $4 million. Not unheard of. And you sold back in February 2022, and you've already filed your taxes for 2023, and you've already paid that. The interesting thing about an LLC, an S corp or partnership, is that they actually have 3 different start dates for the 180-day window. First is when they receive their original proceeds, but second is also on December 31st of the taxable calendar year, or the end of the taxable year, which is December 31st, or it's on March 15th of the following year, which is the corporate tax filing date. So somebody has essentially until, if they sold their business, their S corp or LLC or partnership, in any time in 2022, they technically have until about September 10th of this year to invest into an Opportunity Zone. And if they've already paid their taxes on those capital gains, and yet they still invest into an Opportunity Zone, they have, again, we can't give tax advice, but they should potentially seek to file an amended return, and they could potentially get a refund on that payment that they've already made. So for clients who've already paid it, there's still the opportunity for them, again, go speak to your tax professional. If they invest into an Opportunity Zone, that they can go back and, again, reinvest and try to get that return, that tax return to them. Also, the Opportunity Zone program, unlike a 1031, does not require any type of accommodator or qualified intermediary. It is a very easy process. Once it's filled out and funded, the bank will provide what's called a receipt of funds letter to the client. They provide that one letter to their CPA, and their CPA then fills out a one-page form from the IRS which then allows them to defer those taxes. So the process itself for the CPA, I would say, is a very easy process for them. Very simple. It literally, I think, is a one-page form. And that's it again. But Brett and the rest of the group out there, thank you all for your service.
So one thing I haven't asked, and why did I not ask this sooner? So I don't want to end. We got 1 or 2 more minutes before we end this live stream, but I didn't ask. I should have asked this before. What are the real risks? What's the biggest downfall? And maybe let's go a little bit longer, because we didn't talk about that, because there's no such thing as a free lunch, and there's no perfect investment, and there's not one that's going to do well every single time. You can lose money with investing. You can lose lots of money with investing. So with every good, there's a bad. With every pro, there's a con. So one of my favorite movies, Clint Eastwood, The Good, the Bad, and the Ugly. So what are really the biggest bads or ugly you can see with the potential investing in Opportunity Zone?
Well, the first one that really sticks out is that it's a 10-year lockup. That is illiquidity, and illiquidity is an issue for everyone. Everyone needs to consider that when they make an investment into an Opportunity Zone fund. If you need ongoing income, if you need the ability to be able to sell, shares of stocks so that you can have money for any reason whatsoever, you're not going to have that in most Opportunity Zone funds. So that is number one. Number two, Opportunity Zone funds are centered around ground up real estate development or large renovations. That is a riskier type of ownership than if you're, say, for example, you're buying a shopping center or you're buying an industrial building that has a tenant that has ongoing cash flow. That means the developer has to build the building. They have to lease up the building in the future. They have to do all sorts of things that increase that risk. So to understand the risk associated with development is an important part of it. It's not like you want to have all of your money tied up in ground development, very similar to you want all of your money tied up in one stock. So that is very important. Also, you need to consider, and we try to say this to all of our investors, the tax benefits are great. We're big fans of the tax benefits. And that's really how people hear about opportunity zone funds. Like, oh my gosh, there are these amazing tax benefits. But at the end of the day, as we said, if there are no profits after 10 years, what are the point of tax-free profits? So understanding the local market that the opportunity zone fund invests into, understanding the asset classes that they're building, and understanding who the developers are that are building those buildings, that's really what matters the most.
And just to add one more part to it. Remember, this is with all risks there. Like you said, there are no guarantees. There are no guarantees on the type of returns or the timing of those returns. Obviously, there is a big tax liability that all opportunity zone investors have in 2027, right? And all opportunity zone funds, most of us have some type of refinance event which we expect to occur before then to provide that. But there is no guarantee that can occur during then or even anytime thereafter, right? Obviously, it is of the benefit of the opportunity zone sponsor to provide those type of distributions to our clients to allow them to pay their taxes. But again, timing, and there's no guarantee that 10 years plus 1 day after the opportunity zone fund is closed capital raise, that's when that 10-year timer starts. There's also no guarantee that after that the market is ready for a sale. What if we're in another situation like we're in today, right? And the capital markets aren't suitable for a profitable sale, then you hold that investment longer, right? And it's still illiquid. So again, these are just things to consider, right? Again, for in your example, you have $4.5 million worth of profit. That's why we would never recommend putting the entire $4.5 million into any type of ground up development. There should be, again, talk to your financial advisor, allocate what's appropriate for you, but also consider that if that opportunity zone program does work out, well, there could be some significant capital appreciation that is tax advantaged.
Great. Well, gentlemen, thank you so much for being here again, Eric and P. Suit. I'm Brett Henderson, again, founder of Strategic Wealth Endeavor. So one thing I do want to say for everyone, if you are an investor out there and you have an advisor, find an advisor that has taken the time to learn, to continually invest in themselves and their education, their skill set, so they can provide you the best advice possible. This is something where I'm here. I admit I'm not an expert, but I'm sitting next to experts. So if your advisor is not an expert in every area, they're a jack of all trades, kind of master of none, maybe master of one or two, make sure that advisor has phenomenal professionals around them. So when an opportunity comes up, they can go to experienced team to know if an investment is quote good, bad, or ugly. At the end of the day, though, I will share there is no good investment. There is no bad investment. An investment is an investment, and it's just numbers. No emotion behind it. It's just numbers. It's just math. So it's important to know where you are and where you want to go and have a plan how you want to get from A to B, generally in as short a time as possible, with as little tax impact as possible. So having a strong relationship with a tax advisor, and I would also say a legal advisor, estate planning or business planning attorney, to help you mitigate that your endeavor to help you along that path is very, very important. So again, I'm Brett Henderson. This is meant to be educational in nature. Hopefully you found this to be educational. If you have any questions, I think Hiram, thanks so much for posting the comments as they come in on the live stream. And again, you can reach out to me. My email has been scrolling below. I'm Brett at SWE90. That's short for Strategic Wealth Endeavor. We are fiduciaries, and we're here to help provide education. And we're going to be doing another one of these next month. And actually, it's going to be on business valuation. So what's your business really worth? So there's a lot of different ways to value your business, and you don't know how the heck, what is it? 1, 2, 3, or 4. We're going to have a panel with 3 or 4 different professionals that just value businesses to really help provide that information, that inside the education for you. But PC, you want to say something else? I can tell.
Well, I mean, that next segment you have could be potential opportunities for opportunity zones, right? They're a great group.
Okay. So everyone, thanks so much for being here. This has been phenomenal. Appreciate your time. Give us some feedback, good, bad, or ugly. I'm Brett Henderson. Hiram, thanks so much. Giselle behind the scenes. I want to bring Giselle on. She's like, don't put me on. Don't put me on. We're going to do this quick. So I want to say thank you to the whole team, Hiram and Giselle for putting this together, and the Catalyst team, P-Suit and Eric for bringing us up to San Jose. We get a little tour tomorrow to see some of their actual projects, which if you reach out to me, we can talk about those personally one-on-one and see if they're appropriate. But again, everyone, thanks so much for being here, and we'll talk to you soon. Have a great afternoon. Thanks again.